All right, guys. Thanks for joining us today. Thrilled to have David back here. He's been coming to our offices for many, many years now. Many of our agents have relied on him for his sage insights, and including myself. So every year we love having him back in to demonstrate, all the different things that you could do, to minimize your tax burden. There's a lot of stuff in here that I bet most people don't know. So without further ado, David, let me turn it over to you and do what you do best.
Jeremy, thank you. I appreciate that, bud. Thanks for having me back, although I'm not really back.
Virtually.
Back virtually because of our friend, the coronavirus. Hope everyone's okay, by the way. So you'll see here, just tax reform 2018, and you're like, oh, well, this is 2 years old. Why are we talking about it? Well, tax changes haven't really happened that much since Trump came in office. It's been the same the past 2 years. We'll see how that changes down the road. But now, Jeremy, is there going to be an interaction here, or is it me just mainly speaking?
There's a chat button that I'll ask that everyone holds their questions to the end. But I will jump in if it's something germane to exactly what you're speaking about. So I will monitor that for you, but otherwise we'll hold the Q&A to the end.
Sure. So I'm going to give you a brief overview of the tax code, how it is now, how it affects your buyers and sellers, and more importantly, how it affects you in your pocket with your business. So let's get started. You probably have already realized that there's been some big changes to the tax return itself, or the 1040. The biggest one is the reduction of something called the SALT deduction. That stands for state and local taxes. Now, that's just not property taxes. It also includes state income tax, which luckily in Florida, for those of you who are in Florida, we don't have that, but other states do. This is a big deal. It's capped out at $10,000 total. So I have clients, for example, in New York who are paying property taxes of $17,000, $18,000 and state income tax of another $15,000, $20,000. They used to be able to deduct all of it. Now they're capped at 10, which is a major problem for high tax states. Taxes on rental properties are not affected by the SALT deduction because the IRS views rental properties as a business. So remember that's a big thing. We'll go into that in more detail. So remember I told you that Florida, and when I first came into K Company 3 years ago discussing this, I pretty much said there's going to be a big boom in relocation. And Jeremy, I think you'd agree that that's been true.
Absolutely.
A lot of people moving to Florida. For one of the main reasons is the tax situation is very conducive. So I'm going to skip the mortgage deduction because not much has changed. The standard deduction is a big change. Many of you probably have seen it. You used to be able to deduct $6,300 as a single. That was bumped to $12,000. Used to be able to deduct $12,700 as married. Now it's $24,000. So while that sounds great, the main reason they did this is because they want to reduce people itemizing their deductions. Because that allows them to cut the workforce on the IRS for auditing purposes. So if people are less apt to itemize their deductions, there's less audits. So the issue here is this good or is this bad? Oops, let me go back. Sorry about that. Is this good or is this bad? And the question is, it really depends on your situation. The only deductions you can now itemize are property taxes and state income tax with a cap of $10,000. Mortgage interest is still deductible, as is mortgage insurance premiums if you qualify and you're under a certain amount of income, and charity. Medical you can, but it's still always, and it always has been, pretty hard to get. So the average person is taking a standard deduction. Roughly 75% of the population now is taking a standard deduction. Which some find to be better, some find it to be worse. What you really do need to know is that the dependent exemption that we used to have, which is $4,050 per dependent in your family, is gone. So although the standard deduction went up, it's not all, it wasn't all it's cracked up to be. I'll leave it at that. One of the big things, which a lot of W-2 employees or wage earners are complaining about, is they can no longer deduct their unreimbursed business expenses. If they work from home, they can't deduct their expenses. If they use their car for work and they're not reimbursed, they can't deduct that. They can't deduct their cell phones. A lot of big issues there, which is a major issue for the actual employee-employer relationship. Employers are now being pushed to reimburse their employees because of this. Now, the good news is this doesn't really affect you guys because you guys are not W-2 wage earners. You're 1099 or you're business owners, which is vital. So the big thing here was called the TCJA, or the Tax Cut and Jobs Act. And this was meant to spur the economy by pretty much giving big tax cuts for business. Initially, it was really geared to something called a C corporation, which are the big boys like Amazon or Google or IBM, so forth, so on. They used to have a highest rate of 35% tax on their corporate income, on their corporate profits. They dropped that from 35% down to 21. It was a 40% cut in tax, which is huge. And by doing that, a lot of the big companies that were operating overseas, their businesses were repatriated back to America, which is, obviously what they wanted to happen, which is good. However, small business owners were like, well, that's great for these big businesses, but how does it affect us? We're the heart of America. What are you going to do for us? We don't pay tax at the corporate level. So they came out with something called the QBI deduction, or the Qualified Business Income Deduction. And those of you who've been filing Schedule C's or S Corp tax returns may have seen it in the past years if you had a profit. You pretty much get 20% off on your federal tax for the amount of money you made in your business. So we can go over that in more detail, but example is, if you have $100,000 in income and you have $40,000 in expenses against your income, that's $60,000. So normally you'd pay federal tax on $60,000. You could take another $12,000 off that. Now you're paying federal tax on $48,000. That's pretty much the QBI deduction and how it works. There are layers based on your income of how that would be affected, but for the most part, most of us fall into that category. Again, you can still write off your deductions. You are not a W-2. You are a business owner, so another big tax break. We discussed this already, the QBI deduction. I'm not going to go into the formulas of how it works. At the end of the day, if you're profitable and you show more income than expenses, you will be entitled to this deduction, which is significant. Now, if you're married and you're making more than, I believe it's $316,000 or $317,000 collectively, there's a few different formulas that come into place, which may reduce this a little bit, but you'll still be able to have access to it. Unlike doctors, attorneys, accountants, they're called SSTVs, where unfortunately, you don't get it like me. But you guys don't have that issue, so you'll be entitled to this QBI deduction regardless, as long as it stays in. Now, I have some examples on here. I don't know if I want to go through these in detail because you're going to see that they're pretty detailed here. But we'll do one just to give you an idea of what I'm talking about. So, for example, here's Jane. Now, this is a fictitious person. This is not someone that I have a client. And Jane, in 2017, before the tax code changed, let's pretend she was a sole proprietorship and she was filing a Schedule C. Her gross commissions were $150,000. Her expenses were $44,891. If you see that in the bottom over here, total expenses. So her profit was $105,109. Now, because she was a Schedule C, or a sole proprietor, being 1099 paid to her own name, she had to pay self-employment tax. And here's a big one. I mean, self-employment tax on her $105,000 was $14,851. That's a big number. Now, she does get a self-employment tax deduction against her federal taxes, which is half of the self-employment tax she paid. And here's that exemption she used to have, which is no longer here. Remember, there's a standard deduction, assuming she's not itemizing. Her taxable income after these deductions were $87,000. Her federal tax was $17,559. Jane paid $32,411. This is not an opinion, this is a fact. These are based on numbers. $32,411 in total taxes, $17,559 in federal, and $14,851 in self-employment. Jane took one of my classes at KCO in 2018 and decided to become a PA. And she had the same exact income and same exact expenses. What you're going to notice, though, is that she's no longer paying self-employment tax. She's paying payroll tax because she's a PA, which means she's an S corporation, and therefore she's an employee of her employer, which is the PA, which she owns. Because she's not considered self-employed anymore, she's not subject to self-employment tax, which is a big, big reduction. So now she pays the employee payroll tax and the employer payroll tax, which is pretty much over here right above it, double it. She's paying $4,800 in payroll taxes versus $14,000 in self-employment tax. There's no exemptions anymore, but her standard deduction has gone up. And she also gets that QBI deduction we discussed, which in this case is $14,000. Her total tax paid in 18 was $19,476, which is a savings of $12,934 from the previous year. Now, I know that your head's probably spinning because there's a lot of numbers going on here. So let me just go back for a second and explain how this all works and the benefits. One thing you heard me talk about, and anybody has questions, you can chime in whatever you want, but one thing you heard me talk about is the benefit of having a PA over a filing as a sole proprietorship or a Schedule C, meaning self-employment versus payroll tax. This is one of the last greatest loopholes the IRS offers. It's been around for about 30 to 40 years. S corporations, a PA would be considered an S corporation if it's filed correctly, or LLCs taxed as S corporations do not pay self-employment tax. Self-employment tax is a huge tax. It's 15.3% on your profits. So if you make $100,000 and your expenses, your business expenses are $40,000, you're going to pay 15% roughly on $60,000. That's a big number. Now, if you are a PA or an LLC taxed as an S corporation, there is no self-employment tax. However, you are subject to payroll tax, which means that the IRS requires you to take a reasonable salary for the work you're doing. I like to be around the 40% range. What that means is we look at your profit. Again, let's pretend it's $100,000 in income and $40,000 in expenses. Therefore, your profit's $60,000. That's called your net income. I would take roughly 40% of that $60,000, $24,000, and categorize that as salary or officer compensation. We're going to pay the 15% on that 24. However, the other 36,000 difference is considered a distribution of profits. It's still your money. You're still able to use it. You just don't pay that 15% tax on it, which is a huge savings. Savings about $6,000. It's all strictly based on structuring your business properly. So there's a lot of benefits if you know how to structure things. One thing I wanted to talk to you about as well is who qualifies for the QBI deduction. Any small business does. So whether you're an S corporation, a partnership, or rental property owner, or a sole proprietorship like you guys, you will qualify for it. Any tax structure other than a C corp or an individual qualifies for this deduction. I mean, that's the whole gist. I really want to point out in detail the IRS tax plan strategy that I put in place. And it's not something the IRS gave me. I'm really using the acronym to stick it to the man. But I can save you money. If you're netting income of $20,000 or more, which means your income minus your expenses are $20,000 or more, and you're not taxed as an S corporation, you are spending too much money. If you're starting out and you're new, or you're not earning $20,000 or more yet, but you're doing this full time and you plan on getting there, if you establish an LLC, you have the ability to not start as an S corporation, start as an LLC, which means there's no additional real filing for your business, but you have the ability to structure your LLC as a S corporation as you start earning more money. So let's say all of a sudden you're not doing great, you're not doing a lot of business, and next thing you know, you sell a $500,000 house and you're into a big commission. We can actually backdate that LLC to be categorized as an S corp and save you a lot of money. If you don't have at least an LLC in place, we can't help you. So it's really important to understand, at least have the flexibility. So anybody that is already earning 20,000 or more should definitely be a PA. If you're earning less than that, at least have the LLC, you have liability protection, you have the ability and the flexibility to be taxed as an S corporation down the road and save a lot of money. If you don't have at least the LLC in place, then you're sort of just hoping. In order to take advantage of this IRS tax plan, you need to incorporate or create an LLC. You need to have very good record keeping. And if you are, again, an S corp, you need to take a salary. These things are a must. Record keeping, regardless of your corporation, an LLC, or 1099, is, I know it's a bane of your existence, but it's one of the most important pieces of your business. You know, I tell every realtor I meet, when I do these presentations, I ask, how many people here are realtors? And of course, everybody raises their hands. And then I ask, how many of you guys are actual business owners? And I don't get the same response. And that's really, really important to understand that you are business owners first and foremost. Your business happens to be in the business of real estate, but you need to treat this business like a business. And record keeping is the first part of it. Understanding your profit and loss, where you're spending your money, if your business is profitable, is key to your success. So these three things, are obviously needed in order to save money. This one's needed, record keeping, no matter what. So we talked about, incorporating and opening up an LLC, and it can save you a lot of money. And I'm happy to go over it with each and every one of you if you want to speak with me about, how it could save you money, and go over details of how that would work. In order to incorporate, there's a bunch of steps that have to be taken. You do need to open your entity with Sunbiz. You do need to apply for a tax ID number with the IRS. If you have an LLC, you're not ready to be taxed as an S corporation, you don't need to do anything more than that with the IRS. However, if you do want to have an S corporation structure, you need to apply for S corporation status. When you open a PA or an LLC, it's vital that you register that entity with the DVPR so your broker can pay you that way. Once you do that, make sure you tell your broker that you are operating in that fashion. Give them your new tax ID number. And lastly, you need to have an open bank account for your business. Please, no matter what, keep your business separate from your personal. The IRS loves auditing realtors. I've seen it firsthand. I do a lot of audit representation. A lot of CPAs send me their clients, and many of them have been realtors, mainly because they like auditing Schedule Cs. Keep good records. Chances are, if you have better records, you're going to do more tax deduction. You're going to find more tax deductions. Now, there's various different ways of record keeping, whether it's Excel or QuickBooks or Quicken or using an app. There's various different things you can do. Just don't do the old, I'm going to put my receipts in a garbage bag or a shoebox and save it for later. It doesn't work. Try to track your miles. That's one of your biggest expenses. MileIQ is fine. Other apps are fine too, or you can use a log. Taking a salary is something that we'll get into. I'd rather speak to the people personally about that if they want to incorporate, because it's a little more detailed and some people get mystified by it. And there's a certain way that I do it, which is different than any other accountant I know, mainly because realtors are not the norm business. You guys aren't earning a straight line amount of money each month. You have months where you don't earn money at all because you're marketing and showing houses, and then you have months where you earn a lot of money. So your salary really needs to be tracking your net income. So don't ever expect your salary to be stable or the same each month. If it is, something is wrong. Something is not right. It should move with the amount of money you make and the amount of money you spend. So we'll talk about taxes on your salary and what you need to pay. When you are an S corporation, or taking a salary as an LLC tax as an S corporation, there is a lot more filing involved. So there is a cost to that. That's why I always tell people you want to be netting at least $20,000 to be taxed as an S corp. If you're netting $20,000, you will save $3,000. That's not opinion; it's a fact. It's based on numbers. Think of it this way: if I have $20,000 in net income, 15% is $3,000. That's what you're paying in self-employment tax. However, if you're an S corp, 40% of $20,000 is $8,000. You're 15% on your $8,000 salary. You're talking about what? You're talking about $1,200 that you'd pay in payroll tax. 3,000 minus 1,200, you're saving $1,800. So there's a big savings starting at about $20,000. The more you make, the more you'll save. And this is just an overview of the various advantages of becoming an S corporation or even an LLC. You do have, if you're an LLC taxed as an S corporation or a PA, you will reduce your chance of an audit. That's
Hey,
a
David,
fact.
Jeremy here. Let me jump in for a second. If you would, I think you started your video, so it's now doing half screen, and so we can't see your presentation.
I didn't touch anything.
Oh, maybe I did on my end. Well, if you guys are seeing this watching, you can just click in the middle of the two images and drag to the right to increase the size of the presentation there. Could just be on my end, David. Thanks.
No worries. So, sorry about that. If I did something, I don't know. So what I was saying is that you will lower your taxes. It's a fact. If you're making 20,000 net or more. If you're making 20,000 net or more, you should be an S corp. If you're not there yet, you should be an LLC if you plan to get there. If you plan to make $20,000 or more and you're not there yet, be an LLC. You have the flexibility at least to plan. Tax planning is the most important thing. Believe it or not, the biggest expense we all face in our lives, unfortunately, are taxes. Between sales tax and payroll tax and property tax and federal income tax, it's an immense amount of money you're paying throughout your lifetime. I'm trying to give you a window into how you can start lowering that a little bit at least. And in some cases, if you make a lot of money, and a lot. So, and also, lower your liability. Having a separate entity that you're working under reduces your legal risks. You're no longer operating as an individual. Your personal assets are now protected, which is a big deal. Now, remember I said that you can lower your audit risk? Again, this is not an opinion. These are facts. The IRS every year, they're usually 2 years behind, but every year they come out with something called the Internal Revenue Service Data Book, which is what you're looking at right now. The Internal Revenue Service Data Book, one of the pages, which you're seeing here, discusses the examination coverage on the actual number of tax returns and types of tax returns they audit. Now, on the very top, you'll see taxable returns. Taxable returns are returns they actually charge tax on. 1040s, which are individual returns, as well as C corporations and estate tax returns are some of those. If you see here, the top line, individual income tax returns total. There are 147 million tax returns filed, 1040s. 0.7% or 7 out of 1,000 of those were audited. Now, non-business returns on a 1040, which do not include a Schedule C, E, or F. Let me explain what that is. A Schedule C is for independent contractors like yourself who are paid on a 1099. A Schedule C are people who own rental properties in their own personal name. And a Schedule F is someone's operating a farm in their name. Those are the three items that make a 1040 a business type tax return. Okay, so if you go to below here to this box, you'll see non-farm business returns. So a non-farm business return means a Schedule C or Schedule E tax return. The chances of being audited for gross income of $25,000 and above is roughly 2%. So you jump from, let's say, 0.7% or 7 out of 1,000 to 2%, 2 out of 100. That's a huge jump. This tells us the IRS likes to audit Schedule Cs. Why? Because they can get federal tax dollars off you and they can get self-employment tax dollars off you. They're double dipping. Let's go down a little further and you'll see non-taxable returns. Non-taxable returns are tax returns that no taxes are charged. Those are partnership returns and S corporation returns. You'll notice if you're a PA or an LLC taxed as an S corporation, your rate of audit is 0.3 or 3 out of 1,000. So 2% or 2 out of 100 for a Schedule C filer versus 3 out of 1,000 for an S corp filer. It's a huge difference. Huge.
Dave, I'm going to jump in again here. Sorry, this is something that we're all seeing. Scroll to the bottom of your screen, lower left-hand corner, and it should say mute, start video. It's showing a little thumbnail for you. It says David, and that's your camera that's on. So somewhere in the settings, it just got clicked. No big deal. Like I said, everyone can just go in the middle of the two images, right click and pull over, but it is very still, even when it's 80%, still hard to see what you're showing us.
Trying to see what I could find here.
We can't figure, we'll just move on, but I figured it's worth hunting a little bit.
Is that better? I don't know what you're saying.
Yeah, so what you don't see and what we're seeing is there's a thumbnail that popped up that has your name. If you had a camera, it would show you, it's your camera view. So on mine, I have a mute and a start video. So if I start video, it will do a pop-up. If you don't see it, no big deal. Don't want to break the continuity here.
Yeah, I just don't know what I don't know, I don't know how to do this. I'm sorry.
That's all right, David.
Okay, hold on.
Just thought I would check real quick. All good. Keep moving on.
Is that better?
Well, now I see a picture of you. There's got to be a way for you to stop it. Hey, David.
Yeah, hold on. Let's see here.
It should say stop video somewhere.
Stop video. Got it. Okay.
Where? It still shows your screen. Well, it didn't take it away. Don't worry about it. Just keep moving on. We're good to go. Everyone can maximize their screen and just move that one image larger. Good.
Okay. So what I was saying is, if you look at these audit numbers, they're significantly different. What I'm trying to tell you is I'm giving you the keys to the kingdom here. I'm showing you that you can definitely reduce your chance of audit risk. Significant. You can definitely save money. Again, numbers don't lie. Unfortunately, people do, but numbers don't. Whatever the numbers are, the numbers are. And I can tell you for a fact, legally, because the IRS allows S corporations not to pay self-employment tax, as long as they take a reasonable salary, you can take advantage of this. Hundreds of thousands, if not millions of people do every year. Florida is one of the states that allows realtors to operate as a PA. So you have that ability. If this is your full-time business and you're making money doing this, stop flushing your money down the toilet. And, you know, at the end of the day, my goal is to help you guys. I deal with a ton of realtors. I understand your business. I know that it does ebb and flow. And there's sometimes when it's slower than others, and sometimes when you're so busy you don't have time to breathe. And sometimes when you spend a lot more money, and sometimes when you make more because that spending is now paying off. But, you know, at the end of the day, please use me as a resource. I'm happy to help you. My goal is to let you keep more of your money, because at the end of the day, making money is important, but keeping the amount of money you made is just as important. So, you know, that's one of the reasons that, you know, I'm here. I'm looking to try to help you so we can, you know, let you keep more of your money and hopefully you become a little more wealthy. Again, to summation, in order to do a PA or an S Corp tax as a PA, you need to have it in corporation. You need to open a PA. You need to record keep regardless. That keeps you out of trouble. That's one of the most important pieces to this. And if you are a PA, you need to take a salary if you're profitable. I know this sounds a little overwhelming, and it can be, but you know what? I wouldn't buy a house without a realtor, and I'd hope you wouldn't start doing tax work like this without someone who knows how to do it. And again, I urge you, if you're not making the 20,000 net yet, but you are looking to get to the next level and you're taking your real estate business seriously, I strongly recommend you be an LLC. As you start making the money, we have the ability to save you the money by being flexible and having the LLC taxed as an S Corp when needed. If there's no structure in place, I can't help you. All I can do is say, well, you could have saved this, but unfortunately we can't. So please, tax planning is everything. We already discussed the benefits. So I think, this is the whole thing. I like to, take any questions you have if I can figure out how to do that. Here's my contact information up there. You could avoid the text. They don't really do that anymore, but definitely my email, my phone. And Jeremy, I'm happy to be open to any questions or comments or concerns other than anything to do with the coronavirus.
Oh, then that removes all my questions.
Can I call you right back?
So if anyone has a question, go ahead and type it into the group chat here, or I can unmute everyone. Everyone's unmuted here, so if you guys want to verbally give David any questions here. Again, David has been doing this for many, many years, and neighbor is asking David if she's currently a PA, should she also become an S Corp?
Well, if you are a PA, you better be an S Corp. Otherwise, you're a C Corp and you're taxed like Amazon. Now, Amazon doesn't pay
any taxes, though, David. So
I was about to say, Amazon doesn't pay taxes, but that's beside the point. For a small business, you need to be an S Corp. Otherwise, the problem is if you're a C Corp, you're going to pay tax at the corporate level because you don't have work credits like Amazon does. So you're going to be taxed at the corporate level. And then when you pull the money out, you're taxed again at the personal level. It's called double taxation. So when you open a PA, it's very important when you get your EIN number to make sure you have an S Corp status. And if you don't, we need to talk.
thank you.